Good morning. It's Thursday, the 14th of December here in London. This is the Bloomberg Daybreak Europe podcast. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, the Fed holds rates steady and gives the clearest signal yet that the next move will be lower.
The focus shifts to the Bank of England and the ECB to see if they will follow Powell's pivot.
Plus, the cash clawback. UBS steps up efforts to recoup bonuses from Credit Suisse defectors.
Let's start with a roundup of our top stories.
Federal Reserve policymakers expect 75 basis points of rate cuts next year, according to their latest dot plot forecast. The pivot comes as the central bank opted to hold rates steady at Wednesday's meeting at a range of 5.25% to 5.5%. Federal Reserve Chair Jerome Powell insists tightening remains an option if price pressures return, but says the FOMC has also begun discussing when to ease.
The question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world and also a discussion for us at our meeting today.
Powell used his press conference to emphasise the rate cut projections are not a preset plan, and while inflation has come down, it's still too high. The prospect of easing policy drove an extended overnight rally in Treasuries, with 10-year yields falling below 4% for the first time since August.
The Fed's rhetorical pivot has led to a surge in stocks, bonds and currencies and one of the biggest post-meeting rallies in recent memory. Virtually no corner of financial markets has been left out of the cross-asset advance. Global shares have spiked higher, front-end Treasuries have posted their biggest day since March, and currencies have surged against the dollar. Jeff Rosenberg, BlackRock's systemic multi-strategy fund portfolio manager, says that he expects that to continue.
There are some, vulnerabilities, but the message and the concern, no one's looking at the vulnerabilities. They're looking at the validation. And so with that validation, this bullish sentiment can go on for a while until we get a new round of economic data. And until then, I think the message is pretty clear that the Fed is more than willing to see an easing in financial conditions, won't step in the way of that.
As BlackRock's Jeff Rosenberg hinted there is no guarantee that the rally will last, but markets have piled into rate cut wagers numerous times over the past 2 years, only then to be caught flat-footed when the Fed didn't change tack.
Turning to the Bank of England, markets have fully priced in 100 basis points of rate cuts from the MPC next year. Soft GDP data drove those bets higher. Bloomberg's senior UK economist Dan Hansen says UK growth in October was weaker than all the analysts had expected.
It sort of beat all economists' expectations in terms of how negative it was. I mean, I think the thing that struck me, though, when I opened the release was how broad-based the weakness was. The broad picture, the broad takeaway is that services, manufacturing and construction all fell, and you've got weakness across the board.
Bloomberg's Dan Hansen adding that while the economic weakness is extremely unlikely to affect the rate decision itself, it may lead to a more dovish split among policymakers.
Well, today's European Central Bank decision is also being watched for how forcefully policymakers push back against bets on interest rate cuts. The former ECB president, Jean-Claude Trichet, thinks that Christine Lagarde and others could cut rates before the Fed.
In the US, for many reasons, we have still a level of core inflation, for instance, that is now significantly superior to core inflation in Europe. 4.2 instead of 3.6. It's not absurd to think that the first decrease of rates could be in Europe instead of in the US.
Jean-Claude Trichet adding that markets were still overdoing bets that the ECB will reduce rates as early as March.
China's economy also seems to be losing momentum. High-frequency data suggests industrial output figures due will be worse than pre-COVID levels. Any economic weakness will trigger calls for stimulus to meet President Xi's 5% growth goal for next year.
Now to some politics. A drive to impeach the US president is now formally authorised. In a vote on Wednesday, Republicans in the US House elected to escalate a probe into Joe Biden that has been underway for several months. Speaking on the House floor yesterday, the minority leader Hakeem Jeffries pointed to former President Donald Trump as a key influence on proceedings.
We are here today on the House floor wasting time and taxpayer dollars on an illegitimate impeachment inquiry because Donald Trump, the puppet master, has directed extreme MAGA Republicans to launch a political hit job.
New York Democrat Hakeem Jeffries also questioned the legitimacy of the inquiry. The investigation focuses on the finances of the first family, particularly the president's son Hunter. Biden himself denounced the inquiry as, quote, a baseless attack.
UBS has stepped up an effort to recoup hundreds of millions of dollars in cash bonuses that Credit Suisse paid to retain deal makers before the lender's collapse. The story from Bloomberg's Charlie Pellet.
According to those sources and documents seen by Bloomberg, UBS has contacted hundreds of bankers and offered some multi-year payment plans amid efforts to claw back a chunk of the 1.2 billion Swiss francs in restricted cash bonuses known internally as upfront cash awards. The documents show the bank's outside law firms are reaching out to staffers who voluntarily left the firm and threatening legal action if the required amounts are not delivered. In New York, Charlie Pellet, Bloomberg Radio.
In a moment, we'll get more on today's central bank decisions. But first, as we're thinking about the Bank of England's decision today, interesting to see the latest data on the UK property market. Property surveyors, the most optimistic they've been on future house sales in almost 2 years. This as mortgage rates have just come off their peak. Now, haven't dropped dramatically, but certainly have come down from the high levels. The average 5-year mortgage rate now down closer to 5% from a peak of 6.1% in July. So it does look like this slow puncture is still happening in the market, but perhaps we're turning to more of a stabilisation than perhaps the bigger falls we had been expecting.
Yeah, it's hard, isn't it, to come out with new superlatives all the time. But this year's been quite extraordinary in terms of the whiplash in financial markets. There were some even who thought there was going to be a big crash in the housing market at the start of the year. I mean, it was an outlier view, but now much more stabilisation as we come to the end of the year than many had thought.
Yeah, indeed. These are the latest figures from the Royal Institution of Chartered Surveyors, but I would also note our colleagues reporting on the high-end country home market, fast becoming part of the nation's property slump. A home in luxury country destinations less likely to sell above its asking price than a home in London's most affluent districts, and that's the first time that's happened since 2015.
Oh, okay.
In case, Caroline, you were thinking about investing in a country pile.
Listen, there was a moment in the pandemic, there really was, but no, that moment has passed, I suspect. Right, let's talk about the Fed. The pivot is real. From the steepest rate increases in decades to contain surging inflation, Jerome Powell and his colleagues issued forecasts showing a series of cuts would be likely next year. Joining us now to discuss, Bloomberg opinion columnist Daniel Moss. Daniel, great to have you with us on the programme this morning. So the Fed pivots at the door, 75 basis points potentially of cuts. No US recession. This is surely an early Christmas present for the markets.
Well, the Christmas present actually began before one of the clips you played earlier. His comment about having discussed how they might begin to cut came in response to a question. There was a real tell, though, in his introductory statement when Powell said for the first time, or rather he characterised the current level of interest rates for the first time, certainly that I've heard, as being, quote, well into restrictive territory. Now, what's the significance of the well? It means they can kind of have it both ways. They can cut and still say they're in restrictive territory if at current levels they are well into restrictive territory. And things flowed from there once the Q&A began. But yes, your remark about no recession. Now, he was at pains, Jay Powell, to say he wasn't declaring victory, but gosh, some of the way he framed the economics of 2023 sure sounded like he was feeling pretty satisfied. So it's all but a declaration of victory. He noted how much inflation had come down. He didn't think the US is in recession now. He also observed that around about a year ago, many people forecast there would be one. No sign of it yet, according to him. So, it's not mission accomplished, but I could have had a worse holiday.
It's maybe a Maybe a slight bit of I told you so as well, coming from Jerome Powell. If we look at the market reaction, Daniel, too, we're looking at the 10-year yields below 4% for the first time since August. How should we be thinking about this for next year? Jeffrey Gundlach's call for 10-year yields in the low 3% range by next year.
Well, I would say what is most important is the direction. So remember, last year in 2022, I believe it was, when the 10-year yield breached 4% in the other direction, it was like, oh my God, the world's going to hell. Well, okay, now we've just breached 4%, a little bit on the other side, and it's happy days are here again. So, context can sometimes be missing in very exciting moments like this. Jay Powell also flagged, what's going to be one of the real debates as we get into 24, which is really, how much has changed. He was asked whether the neutral rate of interest, after everything we've been through in the past couple of years, has changed very much. He sort of almost sounded like some of his academic predecessors, Janet Yellen or Ben Bernanke, rather than a private equity guy and a lawyer that he is. He said, well, it's one of the great fascinating historical questions. We're going to be debating that this year. Which left, something in my mind along the lines of, well, maybe we should be doing a column like, maybe not much has really changed at all. Low interest rates could be back. Transitory might even be resurrected.
Oh, wow, that would be extraordinary.
Back from Elba.
In terms of Powell's commentary in and of itself, do you think that effectively is acting as a rate cut in markets? I mean, again, is this, we had the conversation going in the other direction too on this one.
When we were previewing this meeting, I suggested that he would probably lean against rate cut speculation because the speculation is already there. And he doesn't want markets to be seen to be, getting carried away. Well, I was off the mark on that one. He just leaned right into it. The clip you played earlier, initially the question was what makes him so convinced that their hiking work is done. He explained that they thought it basically was, and then he leant right in without a follow-up question, saying, well, then, once you concede that, then the next point is, when do you start thinking about cuts? I'm like, whoa, okay, all right. He's just leant into it. No point in hiding from it. Pretty impressive, actually.
OK, Bloomberg opinion columnist Daniel Moss, thank you so much for joining us with your thoughts on yesterday's Federal Reserve decision.
Well, from the Fed to a packed day today for central bank decisions in Europe, all of them now with the pressure to pivot themselves towards rate cuts too. Let's bring in Bloomberg's chief Europe economist, Jamie Rush. The ECB first, what can we expect from this final meeting of the year?
Well, I think they're going to be responding to the way the Fed has described the outlook. And so, the last thing we heard from Lagarde was that we wouldn't see any rate cuts for a couple of quarters. Well, Powell said similar things even in the run-up to the latest FOMC meeting, and subsequently changed his view. So I think it's quite possible that we will see a shift in the rhetoric at the ECB. But I don't think it will be quite as they'll be quite as willing to fully embrace market pricing for rate cuts early in the year as the Fed has been. So I think there'll be a little bit more inertia, but I think that pivot is coming, and so we will be probably seeing rate cuts in the first half of the year.
We also get new forecast, Jamie, from the ECB as well. What will you be looking out for?
Well, I think we'll get long-term inflation forecasts, so they roll forward a year. So that'll give us a sense of whether they feel confident that that policy is restrictive enough. They certainly almost will show that inflation is close to 2% at the end of the forecast period. So from their perspective, it will be job done on rate hikes. But again, it's that question about when is the first rate coming, and then how fast will it be? I think that's the next bone of contention with markets. It's not just when it will happen, but whether we're looking at one rate cut a quarter or whether we're looking at one rate cut a meeting.
In terms of the Bank of England, a huge challenge, high inflation, a stagnant economy, and now 100 basis points of cuts priced in for the UK next year.
Yeah, so I mean, the UK is in a slightly different position from everyone because we seem to have the worst of both worlds in the sense that we had that huge supply shock which pushed inflation up, and then we had that interacting with a very tight labour market to send wage growth above 8%. So I think it's we're looking at a slightly stickier outlook for the UK. At the same time, if the global mood music is changing, the Bank of England is not going to be immune to that. So I think we, again, will be seeing some discussion of the possibility that rate cuts are coming and maybe a little bit less of this Table Mountain nonsense that we've been hearing about for so long.
What about the split between policymakers, Jamie?
Yes, they'll probably still be slightly divided, and there hasn't been unanimity at the Bank of England for a while, so I expect that to continue.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.